In this week's update, outlook for silver, the most important information right now, and we'll have a look at the Bitcoin chart as well. My name is Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, I'm going to start with something a little different this week. Most people, in my experience, think that good stock recommendations or some guru who's telling you what's coming next are the keys to how you should play this market. And that's natural, and it's an attractive thought process. But look, it's not even close to the most vital information that you need to both make money, but also, more importantly, to keep it. Now, I've been getting a lot of questions of late, so it seems to me as there's been an upswing in the amount of doom and gloom videos that are out there, or the doom and gloom books that are telling us that the world's about to fall apart. CNBC seems to be out with radical forecasts all the time. So is it that, or is it just that more people are responding to it? Because I'm certainly getting a lot more questions these days. So I don't know what the answer to that question is, but look, I do know that for serious traders and investors, that this is the information that I'm about to go through now. I think this is by far the most important thing. And if you pay attention to these doom and gloom books and forecasts, they're only going to mess up your mind, or even the positive forecasts, in fact. So paying attention to this stuff really is not doing you any good at all. It's actually a negative. It adds no value at all, because really no one knows what's going to happen. People that are putting out these forecasts are either just guessing, they're grandstanding, they're trying to promote their services, or they're trying to sell a book. And the best way to sell a book is to, put out a pretty bad story that everybody wants to read. But it is worse than adding no value, because it prevents you from thinking clearly and seeing what's going on in the market for what it's worth. So my strong recommendation is that you need to assign almost no weight at all to these doom and gloom books and videos, because they're just not helping at all. So the things that we should focus on are questions like these. What do I want my portfolio to look like when it's fully constructed? How do I enter? What is the process I'm using to buy into stocks? Am I buying dips in established trends? Am I trading a range? What am I doing here? There's many different answers, but you've just got to be clear about the process that you're using. How big should the positions be? These are all questions that are all vital, but in my experience, a lot of people don't bother to pay much attention to them. Really importantly, how do I take profits and set stop losses? This is the most difficult one for most people, and this is where I get, I guess, a lot of questions in Portfolio Analyst. And then, of course, you've got to develop the discipline to execute your game plan consistently. And I talk about this every week, but I know from the questions that I get, both within and outside my membership services, that most people still really aren't getting down to the sort of clarity that they need to. So if you focus on these things rather than the books and the videos and the CNBC forecasts, then you're going to make far more money. I'm absolutely positive about that, and you'll get to keep more of it as well. So I'd really encourage you to, I'm just saying, don't read this stuff, don't view the videos, but just assign almost no weight to them. They're just an interesting piece of information. They're nothing to really incorporate into your market activities. All right, before we get on to American stocks, let me just touch on Bitcoin first of all. So Bitcoin is on an absolute tear at the moment, and it closed the week at just shy of $56,000. So it was only a short while ago, back here in October, we were trading at $11,000. We went up to $20,000. We spent a little bit of time there in what looked like a bit of a volatile range, but when you look at it now, it looks like it's almost flat-lined. We then had a huge surge. We got another consolidation period. I thought that this consolidation period would go longer because of the nature of the candles and the fact that a lot of volume came out on the initial downswing. That generally points to a more extended period of consolidation. But look, not to be. And on rising volume, Bitcoin has just burst out of this trading range, which had an upper limit around 40,000, and it's just absolutely screamed up now to 56,000. Look, all I can add at the moment is you certainly wouldn't want to be buying into it at the moment, when just from a purely technical point of view, with the price so extended above the 20-day moving average. But I think the best thing to do is, again, come back to my opening comments, and that's clarity about what you're doing. So why do you own this? Are you sitting on Bitcoin for the next 5 years, 10 years? Or are you trading it, periodically taking profit? Both are valid strategies if you want to be involved in cryptocurrencies. But you just need to be clear on which one you're adopting, and don't make it up as you go. And if you're trading it, then what is your process for taking profit? There's many techniques for profit taking. So again, just be clear in advance. You don't have to know what price you're going to take profit at, but you need to know what market signal you're going to respond to. So that's about all I can add on Bitcoin at the moment, but it's certainly having an amazing run. Now, the American market fell 0.7 across the week. From my perspective, there really wasn't much else going on in the last week than options expiry. And I won't go into the detail of that because it's a little bit complex. I've explained it to my members. And really, it's a period of reasonably contrived action where market makers are really exploiting the opportunity to make more money than they otherwise would. So by and large, what happened in the last week, we got a dip, particularly in a lot of small caps, can be pretty much ignored. And there was certainly a bit of a turnaround last night. I don't know what will happen next week, because often in the week following options expiry, you can get some volatile ups and downs. But beyond that, all the signs are pointing to the rally continuing. It's really looking extremely positive. The economic data is certainly good enough. The earnings data is certainly good enough. And yes, the bond yields are rising, and that is something that needs to be watched carefully. But bond yields aren't yet to a level where they're going to cause any sort of issue with respect to money coming out of equities and going back into bonds. We're nowhere near that point yet. But the other point that I'll make, and this is really critical, is that you shouldn't think about the market as just one overall entity and you're either in or you're out. I think we're going to see increasingly the market splitting into the really high growth, high probability megatrends are going to continue to do really well. And the rest of the market, particularly if bond yields keep going up, the rest of the market, money will flow out of those sections and quite possibly go back into bonds again if yields keep rising. So, I still think there's going to be significant rallies in individual sectors and individual stocks, even if the overall indices are not doing so. US dollar slipped a little bit, but look, it's still just tracking around this 90 mark. The 10-year yield has pushed up again, so we're up to 1.34. Now, somewhere between 1.5% and 2% is when things start to get interesting, and I think we'll start to see some parts of the market perhaps experience some pullback. So, beyond 1.5 to 2, I think things need to be watched carefully if valuations stay where they are. Now, also the VIX is still fluctuating up and above and below 20. So, that's given what's going on, all things considered, that's still a pretty reasonable level for the VIX and isn't indicating that we're likely to see anything dramatic in the market. So at the moment, all the signs are relatively plain sailing. Let me just check in on the VIX. So there's the VIX index. So you can see the spikes to above 30 that we got that's September of last year. Then we got another spike in October, went above 40. We got another spike in late January, where it ran up to 37.5 on a closing basis, but intraday it got very close to 40. And at the time I said that it was probably going to be quite short term and that we were probably fairly close to a bottom, and that's in fact what happened. And when we look at the S&P, if we look at that week around the 27th of January, you'll see what I mean. And the VIX has fallen very, very sharply, and as a consequence, stocks have gone up. So that's where we sit with the VIX. Let's look at the S&P. Okay, so here was the low in January. There's the week of the 27th. So the VIX, the spike in the VIX to close to 40 certainly pinpointed the low in the market, and the US market was down just a touch across the week. But as I said before, that's largely around the options expiry period, which is really for most people, unless you're a really short-term trader, is really something just to be ignored. All right, turning now to Aussie stocks. The Aussie dollar went higher, quite a big gap up on Friday, as we'll see in a minute, and our index slipped just a handful of points, down 0.2%. This is what I said last week, and it's still the most relevant comment I can make, I think, and that's the best risk-adjusted returns in the Australian market is in high-growth small caps that are bought with a clear game plan in mind. There are a lot of value traps out there. Stocks paying a high dividend, the dividends are not sustainable, and it's going to be the double whammy effect of you're not going to get the dividend that you think you're going to get in future years, and that's probably also going to impact on the share price. So you're going to lose on the share price, and you're probably not going to get the dividend that you expect. So just be very careful out there. Okay, so turning to the US dollar. So really just tracking sideways, and the Aussie dollar, you can see quite a sharp gap up to 78, over 78, and you can see that we're now tracking back towards the recent highs that were back in fact, we've got to go all the way back to 2017, 2018. So certainly the Australian dollar looking very buoyant, and the way that commodity prices are going, it's hard to see the trend in the Australian dollar turning down, certainly at the moment. One other chart I wanted to look at too, of course, was the Russell 2000, so small caps. So we had a dip, but look only to the 50-day, and that's pretty much all it's done since March of last year. We've come back to the 50-day, occasionally just a little bit below it, but it's a really solid looking trend. The Australian index, so we got up close to 7,000, didn't quite make it, and quite a sharp sell-off on Friday. But one would think that will probably reverse itself a bit on Monday. Now, looking at precious metals, there's the gold price on a daily basis. So gold is really struggling, and we're now down at an important support level. So if gold breaks this level, then we could see a further run down and below 1,700. I think I said last week that I was concerned because gold had really done nothing during the seasonally strongest period of the year, from November to sometime during February is generally when it sort of peters out. And the fact that gold had been unable to lift during that period is a concern, and we're now entering probably one of the weaker periods of the year from here till June. So the outlook in the shorter term for precious metals, or particularly for gold, is not all that great. I think part of the reason is that the market's doing so well, and you've also got Bitcoin and cryptocurrencies getting so much attention that there's really just a bit of a lack of interest. And then the other factor is that bond yields have gone up, and that makes the fact that gold doesn't pay a dividend, that makes gold a little less attractive as well. The fear has gone out of the market, so gold doesn't have a lot of things going for it just at the minute. And if we look at it on a weekly basis, you can see we've now dropped out of this trend channel. So if we extend this line up here, you can see we're now out of that trend channel. So I don't know what's going to happen with gold from here, but I think silver certainly offers better opportunities, and I'll cover that point in just a minute. And you can see just how much stronger the silver price is. Just look at the moving averages, the red 200, the blue 50, and the green 20, all lined up in the right way, and the price above all of them. Yet if you go back and look at gold on a daily, all the moving averages are rolling over, and the gold price is below it. So very, very clearly, silver is outperforming gold. So gold sharply lower, down to 1784. Silver was steady in the low $27 area. And the key thing about silver, and this also applies to platinum and palladium as well, is that the silver demand is growing. So this is demand as an industrial metal. And that industrial demand is not fickle like investment demand, which waxes and wanes depending on a lot of other factors. And there are so many new applications developing now for silver, and also for the other white metals, that the outlook is really much stronger. Precious metal stocks, gold stocks were weak, as we'll see in a minute, but silver stocks are outperforming for a very good reason. So I'll just touch quickly on those. So we'll look at GDXJ. So this is, I think, a more appropriate index to be looking at, because it covers a much broader part of the market. It really excludes the majors, and a lot of the majors are really just going sideways. So GDXJ gives you I think a better representation of what gold stocks are doing around the world. So you can see, looks pretty similar to the gold price in respect of what the 200-day and the 50-day moving averages are doing. But if we look at the silver ETF, again, it looks quite similar. The 200-day is still rising. It's not quite as clear-cut as the silver price, but it's still far more positive. So if you're looking to be in the precious metals area, then have more of an orientation to silver stocks than gold stocks. So let's just unpack this a little bit more. This is a graphic that shows the various uses. You can see industrial applications over here is this huge dark blue segment on the right that makes up about 51% of total silver demand. For solar panels, electronics, they're all increasing. Of course, batteries and various biocidal properties of silver as well. So when you look at that, and the fact that all these applications are all rising fairly quickly, jewelry is becoming less, an investment, 18%, and so on. So you can see that the real growth area for silver is, or the largest area, is going to keep growing, and I think become a bigger portion of that pie. So we've got rapidly expanding usage. It's electric vehicles and the electric vehicle infrastructure, so the battery charging infrastructure that's going to have to be built out around the world. And despite what you might think about how electric vehicles are going to take over the demand for vehicles, the fact is that regulations are really supercharging the adoption, and it's very hard to see that changing. The momentum behind this shift to green energy and away from fossil fuels is, I just sense it's just getting stronger and stronger and stronger, and I think it's become really self-propelling now. It's hard to see things taking a backward step in that regard. Of course, solar panels are obviously going to be a huge growth area. 5G infrastructure, there's a lot more silver required in the 5G base stations that are going to be required, and of course there's a lot more base stations than for 4G. So the outlook there is very strong. If you look at supply, there's been underinvestment in silver and gold. for quite some time because of the lower prices. That underinvestment has really persisted to a degree. Silver often tends to be a byproduct of either base metals production, and also we've had falling grades are also leading to lower production as well. So the supply outlook for silver is is not all that strong, and it's clearly going to struggle to keep up with that very expanding demand side. All right, turning to other commodities, copper shot up above $4, finished at $4.04, and nickel also much stronger as well. I think it was about $8.30 last week. So a lot of strength in base metals. The underlying demand is really set to keep rising. I think the outlook for the next 5 years is pretty strong for all those areas. Tin is doing really well. The amount of tin in warehouses around the world is almost non-existent. So base metal price is doing very well. So we've got long-term trends that are now in play. We've got reflation, which would have helped anyway, but now we've got all these expanding usages for for copper and for nickel. Crude oil got above 60 at one stage, finished around 59 to end the week, and it's a bit sort of paradoxical here with fossil fuels usage and the long-term outlook being pretty cloudy. You would have thought that prices might be under pressure. But what's actually happening here is that the production outlooks, so the intentions of the players in the industry are actually worse than the growth in demand. So there's perhaps a slowing of demand growth, but the production outlook is even worse, and so that's tending to keep the pressure on the price. So we might even see the crude oil price push up higher. But look, I prefer to stay with the mega trends. There's a lot more certainty in those areas, and that's what I search for most of the time, the highest probability that I can find in the market. So there's the copper chart. You can see it's been a real surge from $3.50 just in the last handful of weeks. And there's the nickel price having done something similar. So to wrap it up, of course, there will be corrections and pullbacks this year. It's just how it works. The market gets ahead of itself, and then you have to get some profit taking, and you get a pullback. But all the stars are aligned really for this rally to continue. So yes, there'll be corrections, but net, I think the direction is up. It's supported by, as I said earlier, the economic data, the corporate earnings data, unless the Fed has, unless inflation takes off, and people have been talking about inflation taking off since 2010, and it hasn't. But unless inflation takes off and the Fed is forced to raise interest rates from effectively zero, then I think you can look for this rally to continue. It's important not to get greedy. Don't get stars in your eyes over this. Take some partial profits on on your well-defined reversal signals. You need to understand what signals you're responding to, and there's certainly many different ways to do it. I've maintained for a long time that our greatest risk is not in the stocks that we buy. It's about the clarity of how we're playing our game. So I'd really encourage everyone to give more and more thought to how you are attacking the market. Portfolio analyst last week, there was a lot of question and answer around all sorts of things, but particularly around market crashes, which is really why I've put that up on the agenda this week, because I'm sensing that a lot of people are consuming this material. They're getting concerned by it. They're confused by it. And it's inevitable that if you take it in, you are going to make decisions that are not in your best interest. And so just try and ignore all that stuff that's out there. We also looked at the progress in the portfolios, which have done extremely well, and reviewed plenty of stocks as well. So that's it for this week. Anyone that would like more information, there's the website address and my email address as well. So I'll be back with you next Sunday. Cheers.